This is a view inside the account during trading hours. You're looking at the month-end results for January 2011. The cash balance at the start of the trading year, 03 January 2011, was 50,000. If you take the profit of 4,200, 4200, I'll just use a round number, divided by the start of year cash balance of 50,000, you get a gain for the entire portfolio of about 8.4% for the month. Even before you calculate the metrics, characteristically, what makes for a consistently managed portfolio are these following characteristics. The largest loser, that's 450, does not wipe out the largest winner. The largest winner in this case is 875, above the value of the largest loser, that being 450. There are more winners, and the winners are progressively larger in their profit value. For the entire account, the profits should step up gradually. The profits should step up consistently like a ladder from the low hundreds to the higher hundreds and move up between the mid to high hundreds and beyond. Profits that jump from the low hundreds directly into the higher hundreds, that signals an over-reliance on gapping plays, which fail to help you step up consistently profitable results. I've calculated the portfolio metrics, that is the win-loss probability, the number of wins per one loss, the average win to the average loss, the performance ratio, and the positive expectancy per trade. That you can see in the static screenshot on the website. At every month end, this view into the account and the metrics are updated so you can see the year-to-date performance. This trading account was configured as a multi-asset class portfolio. With the traded products, you see XME, Metals and Mining, a commodity index, the ERX, and the FAS. These are leverage sector specific ETFs, exchange traded funds. The VIX, the volatility index tracking the S&P 500 in addition to notable equities. As the portfolio was structured using traded products from multiple asset classes, I'm going to benchmark its relative performance against indexes across equities, currencies, commodities, and bonds. I've selected year-to-date as the period for comparison using the perf chart at stockcharts.com. I've just enlarged the chart. This is the year-to-date performance from 31st December 2010 till 28th January 2011. For equities, I'm using the Dow Jones, the SPOOS, that's the S&P 500, which is the most widely accepted performance benchmark for equities, and the NASDAQ 100. For currencies, DBV represents a basket of the G10 currencies, which includes US dollars, euros, Japanese yen, Canadian dollars, Swiss francs, British pounds, Australian dollars, New Zealand dollars, the Norwegian kroner, and the Swedish krona. For commodities, the benchmark used is GSG, the iShares Global Commodity ETF, which tracks 24 different commodities across energy, agriculture, industrial metals, livestock, and precious metals. For bonds, the benchmark is the iShares Credit Bond ETF, which represents the investment grade credit sector of the United States bond market as defined by the Barclays Capital US Credit Index. With the year-to-date gain of 8.4%, the portfolio is beating the external benchmark's year-to-date performance. Now let's compare the retail portfolio's gains of 8.4% against professionally run hedge funds. Hedge fund research specializes in the areas of professional index trading and analysis of institutional hedge funds. So, looking at the last month's performance of these indexes, the humble retail portfolio, structured in the study room with its 8.4% year-to-date gain, has beaten institutional hedge funds across all the different asset classes, including hedged currency funds.